And so we're going to jump into it today. And Matt, as we always do, let's start with the lending side of things and talk a little bit about these interest rates. So we just got our announcement the other day from the Bank of Canada. We did get a hold. It's kind of what you and I had anticipated. It was kind of a coin toss to be if it was going to happen or not, if I remember right from our what we were seeing in the predictions. But nonetheless, we get a hold. So here we are.
Yeah, I think inflation's still a little bit sticky. I think they're still a little bit worried about just how much the tariffs might affect prices. Also, the government of Canada has come out and said, hey, you know what? We're not going to put a budget out this year, this spring. We're going to wait till the fall. And I think one of the key reasons they're waiting to the fall is because they're going to be spending a lot of money and they're going to be putting a lot of money into the economy for multiple reasons. A, we let the resource sector, uh, basically falter over the last 10 years. And I think the new government realizes we can't just be reliant on housing in this country to drive the GDP. We need other avenues of income and business. So they're going to be pumping a lot of money into that. They're also going to be pumping a lot of money into the sectors like the steel and aluminum sectors that are going to need help while we negotiate with the Trump administration as to coming up with a deal. So I think there's going to be a lot of money potentially put in the economy that's going to affect interest rates as well, because it might to the upside a little bit, cause some inflation. And
Mhm.
also wages. Wages have still been up there a bit. We're seeing Canada Post coming out looking for 19%. A lot of different unions, a lot of different people are asking for bigger pay to help with inflation, but ultimately, that can cause a little bit of inflation as well.
Right. And so again, that's important to note. So as you've got people sitting on the sidelines wondering what's happening with rates, this is where we're seeing that stickiness a little bit, particularly when it comes to the inflation, as you mentioned. Now, talk to me about our 5 year government bonds and how this kind of impacts our fixed rates as opposed to the Bank of Canada, where we're looking more at our variable side options.
Yeah, I mean, fixed rates bond, it's bond investors. It's it's basically who's willing to buy the government debt. And the higher that interest rate goes, basically means there's less and less people that are willing to buy it. So they have to offer up a better rate. So we can see it's been sticky at the top there. Bond investors are a little bit worried right now because of how much government debt there is out there, and it's a little bit risky for them because they in their minds are like, okay, is it worth the rate that I'm getting to hold this bond from a government that's severely in debt? And we're starting to see the prices of gold go up because central banks are rotating some of the US dollars, some of the US treasuries, and would rather hold gold because they see that the money printing is going to potentially to have to start continuing
Yeah.
to pay the interest off on the previous debt, and interest rates are ultimately not going to get down low enough. So we're seeing in the bond market it's still sticky. We're still back to where we were in 2010.
2010, yeah. Yeah, right here. And then if for those of you that were around selling real estate in that time or buying and selling houses in that moment, this is where we start to see a bigger increase in average home price. We saw these kind of go to the upside as these rates were impacting and coming down. People were getting cheaper lending. And then, of course, in our 2018, 2019, you saw that go up. Matt, you talk about this segment a lot, whereas I was talking about the impact from the fair housing plan here, but it all happened and it all kind of combined. And as you can see, these climb up. We saw the market really slow and struggle. We saw prices come down. And then this is obviously where we ended up in 2023 as they started to increase from 2022.
The thing with this chart too, what's important is, if we go all the way back to 2001 all the way to 2021, this was a market in where every 5 years you could refinance your mortgage, you could pour all your old debts into it, right? Get a
Mhm.
cheaper interest rate so that it was an affordable amount. And then the next 5 years, you could just repeat the cycle. We're at a point now where it's too high, and a lot of people are starting to have to refinance for the first time in a very
Mhm.
long time at higher interest rates, and they can't roll as much debt from credit cards, auto loans, and stuff like that. So that's
Yes.
definitely one thing that I'm keeping my eye on with rates being the way they are right now, is because in 2020, the last we were down basically at the lowest we've been in a very, very long time. I don't know how far back we could go to go see that amount, but now you're rolling over here, not rolling even lower with the interest rate. So it is something I'm keeping an eye on.
Yeah.